Hi, good morning, students. Welcome back. So today we'll continue with our discussion on AS15. Right, so I'll just share the presentation. So I think it's there. Manish, can you please enable the chat for everyone? Yeah. I'm getting the chat individually. Yeah? Okay, so I'll have to read individually for everyone. You still okay? All right. Okay. All right. Okay. Yeah. So let's do a quick recap in terms of the discussions that we have had as around AS15. So in the previous session, we talked about employee benefits, correct? Now, what are employee benefits? Can you just quickly help me understand? What are employee benefits? Over to you. Yeah. So employee benefits, you can say, could be any benefit. It could be in cash. Okay. It could be in kind, or it could be any benefit. Great. So Navneet says pension, gratuity, salary, all of these are examples, perquisites. Yes. But all of these benefits which are available to any employee, right? Which are available to any employee. But why are those benefits available to the employee? Because the employee has rendered services for the employer. Yes or no? Yeah. Because the employee has rendered services. And in this case, there was also a discussion as around what is the nature of the contract that the employer is having with the employee. See, the important part is that as per the arrangement, it should be worked out in a manner that the counterparty means for the entity, it should tantamount to contract of services and not the contract for services. Correct. We discussed about the difference between these two as to how are these two different and what is the implication. Yeah, important thing for the employee benefit is what? First step, employer and employee relationship needs to be established. The moment you do that, then obviously all of these pointers will get covered. Correct? Yeah. Okay. So now moving further. Now, in relation to the employee benefits, we discussed that it could be a part-time employee, it could be a full-time employee, or it could also be a casual labor. Yeah. The moment you say it's an employee, it will get covered. Now, once the employee-employer relationship is established, and we have established that there is an employee benefit, which will fall within the purview of the standard, then what is the next step? For the purposes of accounting requirements, we then need to bifurcate those employee benefits, or you can say categorize into four categories. What are those? Short term, post employment, other long term, termination. All right, so now can you tell me what are short term employee benefits? Over to you quickly. What are short term employee benefits? How do you define them? Yes, so Navneet says those which are received in 12 months. I would request everyone if you just send your messages in the chat for everyone. Otherwise, I'll have to pick that individually, which is very difficult. Okay, Linga says wages, salaries. Okay, so that's an example. Ashlesha says wages, salaries. Okay, Archana says accumulating and non-accumulating. No, that's the further categorization. I'm saying, how do you define short-term employee benefits. Everyone is giving an example. Shamli is saying salary, bonus. Meenu is saying which are payable within 12 months from the balance sheet date. Yeah, very good. So what are short-term employee benefits? Those benefits which become due for payment within 12 months. Yeah, same is the response from Navneet, Archana. Good. Now, as around these short-term employee benefits, there is again a segregation, you can say, sort of, which can be created. And what is that? Accumulating and non-accumulating. Now, how is that relevant? Because depending on whether the employee benefit is accumulating or non-accumulating, its accounting varies. Yes or no? Its accounting varies. So can you help me understand what are accumulating and non-accumulating employee benefits? Over to you. What are accumulating and non-accumulating employee benefits? Yes, over to you. What do you mean by accumulating? What do you mean by non-accumulating? Quickly. Okay, Neeraj says the benefits which are carried forward to next year, those are accumulating, right? Then I can see one response from Nagaraja. Nagaraja, again, I would request, please send your chat in the chat for everyone. Huh? Request. Huh? Everyone, please send your chat in chat for everyone. Huh? Otherwise, individually, it's very difficult. I may miss out on your queries. Nagaraja says these are the benefits that a company provides to its employees and expects to settle within 12 months after the end of the reporting period. Very good. Shamli says accumulating benefits means balance carried forward to next year, which are allowed to be carried forward. Okay, means which can be moved to the next period. I think Navneet has the same answer. Linga is saying those which you carry forward to the next year. Okay. Meenu is saying any leaves which are not availed by the employee and which are carried forward. So that's an example. Okay. Pooja is saying again the same thing. Very good. Then Theomsmi is saying the benefits which are carried forward to the next year. Ashlesha has the same response. Great. Now, as regards accumulating and non-accumulating, what do we need to check? If there are accumulating employee benefits and those become due for payment within next 12 months from the balance sheet date, then what will you call it as? Short-term employee benefit. Correct? If they lapse, then you don't do anything about it, which is non-accumulating. Do you do anything about it? No. Right? Now, this was about the short-term employee benefits. The other one that we discussed, post-employment employee benefits. Okay. Now, can you please explain what are post-employment employee benefits? Over to you. What are post-employment employee benefits? Great. Neeraj says those which are payable at the time of retirement. Okay. Now, in respect of post-employment benefits, I think Linga has already answered this. There are two further, sort of discussions we may have: defined contribution plan and defined benefit plan. Can you please help me understand what are defined contribution plans? Over to you. What are defined contribution plans? I'm not looking at an example. You can just help me understand the definition. What is the understanding around defined contribution plan? Over to you. Nagaraja says benefits that a company provides to employees after they have completed their employment. Great, that's the understanding for post employment. Okay, now I'm asking about defined contribution plan. Teyasumi says those which are fixed in nature. Okay, what else? Anyone else? Great, Neeraj says in the defined benefit, risk is borne by the company. No, that's not correct. Meenu says employer paid provident fund through government recognized fund and the risk is with government. Okay, so that's an example. Shamli says under defined contribution plans, it's not defined contribution benefit, it's a defined contribution plan. Employer's contribution is fixed. Archana says risk will be borne by the third party. Linga says, again, it's an example. See, in case of a defined contribution plan, what is the understanding? The contribution of the employer every year will remain, whether it is fixed or variable, doesn't matter. Important point is any future risk, any future liability, that doesn't fall on the employer once the contribution is made. See, it doesn't matter whether the contribution is fixed or not. Maybe the contribution is increasing year on year. Doesn't matter. Yeah. Important part is that once the contribution is done, no future liability will fall on the employer. Correct? Now, what is a defined benefit plan? Tell me, what is a defined benefit plan? As against defined contribution, what is a defined benefit plan? How do you define it? What is a defined benefit plan? Yes, over to you. Where the liability will fall on the employer, risk is borne by the employer in terms of the future liability. That's what Navneet, Meenu, Shamli are saying. Great. Now, as regards the accounting of defined contribution plan, we discussed that this accounting criteria is very simple. Why? Because any contribution which is payable, that is what you record as an expense. Okay. We were talking about defined benefit plan in the last session. Yes or no? Yeah. Now, in respect of defined benefit plans, now what we will do is we'll just continue on the accounting requirement. Okay, so now, in respect of defined benefit plan, we discussed that the accounting needs to be done using projected unit credit method. Yes or no? And for this valuation, what do you have? You require the involvement of an actuary. Okay, so that's why you'll have an actuarial valuation. So the actuary will be involved who will do the valuation for the company. Correct. Now moving further, what we will do is we will just discuss some of these, you can say, terms which are going to be used in relation to this defined benefit plan. Okay, and then we will start picking up some examples around it. Right? So there were a couple of terms that we used in the context of defined benefit plan. Let me just move on to a working file. Okay. So now, I think Archana has a query. Yes, Archana, please go ahead. You have raised hand. Yes, Archana, please pick up. You have a query? Yes, Archana, please go ahead.
Good morning, sir.
Good morning.
Sir, actually, I have a doubt that last session you have discussed regarding defined benefit plan.
Right,
So I just have on that three queries.
right.
So first one is, sir, what if an entity comes into insolvency? In that case, who will be taking the risk?
See, it doesn't matter whether the company is insolvent or not. Important part is that who is liable to pay the amount. Okay, so let's make it a two-step process. First of all, what do you assess? Who is liable? So in respect of defined benefit plan, we discussed company will be liable. Yes or no? Now,
Yes.
if let's suppose company has a liability, let's say in respect of defined benefit plan. Similarly, company will also have a liability. Let's suppose company has taken a loan from a bank. Similarly, company may have various other liabilities. Yeah. Now the company has become insolvent, or maybe company doesn't have adequate funds to repay. So then that's a separate discussion. Okay. So that's a legal point as to how the company is going to repay that. Okay. Wherein the legal angle will have to be looked at as to how this money will now be repaid or whether this will be payable or not. Understood my point?
Yes, sir.
Okay. Yeah.
And sir, next question is it applicable if the employee joins in the last of his retirement period?
No, I'm not clear on this. What's the query? What do you mean by this?
Like if the benefit plan will be they can be taking in the last of the 20th year, like in his retirement period,
Mm-hmm.
then he can will if he will be joining in the last 2 years or in the 5 years of his
See,
retirement.
that is again a separate aspect to it. See, there are two aspects to it every time. I think this is what I discussed in the last session also. Every time, what do you need to find out? Two things. Let me just break it into two parts. Okay. So one, you have the policy of the company, right? Currently, what are we discussing? We are discussing about accounting requirements. Why? Because we are accountants. Our role is only to do the accounting. For which, what do you use? Use AS. So basically, when you are using AS, you are taking an accounting approach. As an accountant, what do you need to do? You need to understand the policy of the company. Now, what is the meaning of the policy? So employee benefit, which is provided by the employer to employee, that is nothing but an HR policy.
Yeah.
Now, to say that a particular benefit will be given to the employee or not, that is not the role of the accountant to decide. That is something which is always available in the HR policy. Okay. So if your query is that will that be payable or not, can that be paid or not? Of course, everything can be done and everything may not be done. As an accountant, what do you need to understand? You need to understand that whatever is the given policy that you have or whatever is the given benefit that you have, you need to account for it. Okay. Clear on this?
Yes, sir.
Yeah.
Yes.
So now to say that if the, let's suppose employee is to retire in the 60th year, he has joined the company when he is of 58 years. Now, whether the company will provide a particular benefit to the employee or not. So we don't know as an accountant. And do we need to know? No. So the company will decide. As an accountant, what do we check? We'll check the policy of the company. If the policy says yes, it will be given, we'll take it. If the policy says it will not be given, we'll not take it. Understood? Again,
Yes.
if you are expecting the accounting standard to answer this, let's suppose you are expecting, okay, sir, what is there in the accounting standard? AS 15. So AS 15 again is a standard for accountant, for accounting. That has got nothing to do with the policy. Clear? So AS
Yes, sir.
15 is not going to help you on this. Yeah. So let's take out this confusion completely as around the employee benefit or the policy.
Okay.
Clear? Okay. What
Yes,
is
sir.
next?
um, Sir, the gratuity benefits which an employee gets after the retirement,
Hmm.
Can he avail the benefits of DBP?
I couldn't understand this question again.
Uh, like my question is, basically gratuity will be providing by the company to an employee is after 20 years of an employment, right?
Okay.
So if an employee has retired
Hmm.
after 21 years of working in an organization,
Now, how
then
is
will
that
he get?
possible? Now, how is that possible? So when you are saying, let's suppose gratuity is payable to the employee after 20 years. Why? Because after 20 years, employee will retire. Okay.
Okay.
So to say that if it is payable after 20 years when the employee retires, then to say that it will be payable after 21 years. So this is contradictory. Huh? So I'm confused on this. So what do you mean by this?
So actually, my question was like if an like a DBP benefit will be getting by an employee, can he get the both the employees of gratuity and DBP or anyone?
So again, I'm not clear, but what I can maybe in a very limited manner understand from your question is that you are considering as if DBP and gratuity are two different things. Is it?
Yes.
Okay. Now, please understand that DBP is a concept. Okay. Similarly, defined contribution plan is a concept. Gratuity, pension, all of these things are the examples.
Okay.
Understood? These are the examples. These are not the concept. Gratuity is not a concept. For us, when you are talking about defined benefit plan, okay, it's a larger thing. So say if there is a defined benefit plan. Now that is the concept. So we are saying that different defined benefit plans are possible. Means there are a lot of benefits which can become defined benefit plan or which can fall within its purview. For example, gratuity. Similarly, for example, pension. Okay. Similarly, we can say, for example, PF. Yeah. So all of these are the examples which can be considered as defined benefit plan. So you can say it's a type of the employee benefit. Within this type, we may have different examples. Now to say that an employee will get gratuity as well as defined benefit plan, is it possible? Answer is yes. Why? Because gratuity is nothing but a defined benefit plan. Or if let's suppose somebody says that other than gratuity, can the employee be getting any other defined benefit plan? Yes, because there can be various types of defined benefit plans. Now that will again be dependent on the types of employee benefits entities providing, and then on the basis of our assessment whether those employee benefits are defined benefit plans or not. Okay,
Yes, sir.
clear on this?
Yes, sir.
Any more
Any question?
questions?
No, sir. I'm done. Thank you.
All right. Anyone else? Any more questions on this? Anyone else? No? Everyone clear? Okay, I think Ashlesha has already explained this about gratuity. So I am assuming that Ashlesha is only explaining this. Okay, no worries. Sure. So now let's talk about defined benefit plans. Okay, so now we'll continue on the defined benefit plans. Correct. Now for the defined benefit plans we discussed, there are two types of costs which may fall within its purview. And why is that so? Because We are looking at financial year 24-25. Okay, let's suppose this is the reporting year. Yeah. Now for the financial year 24-25, we need to record the defined benefit plan, or you can say the cost of this defined benefit plan. And we understand that even though employee is rendering services today, when is this benefit payable to the employee? Maybe some of the employees are retiring after 10 years. Yeah, so let's suppose some of the employees are retiring after 10 years. Some may be retiring after 15 years. Some may be retiring after 20 years. Some may be retiring after 3 years. Okay, so different periods could be there for different employees. We cannot have a fixed period for retirement of all the employees of the company. Is that possible? No, that is not possible. Correct? So now, in this case, what is the amount that we need to compute? We need to compute the amount that will be payable to the employees when they retire. Okay, for which we discussed an estimation is required, because today we don't know what is the amount that will be payable after 10 years. Yes or no? We don't know. Let's assume this amount after 10 years will be 100. Let's assume. Okay. Now, how do you arrive at this 100? Some assumptions will have to be made. So when the organization will be estimating, see, for estimation, 100% accuracy is not possible. Some approximation will be required. Yes or no? Yeah. Without the approximation, you can't estimate the liability. Right? Now, in this case, the next question arises that if you were to estimate, what are the different assumptions you'll have to take? So some of the assumptions could be increment rate. Why? Because year on year salaries will increase. Yeah, so one of the assumption will be the increment rate. Then you may have another assumption about the mortality rate. Some of the employees may stay, some of the employees may leave. Attrition rate. Yeah. Similarly, various other assumptions could be used for the purposes of estimation of this liability. Now, let's suppose if you estimate this liability to be 100 and you record this liability in 24-25. Each year, what will happen? Next year, let's suppose if you go to next year, 25-26. Next year, when you estimate the amount which is payable at the end of 10th year, will it continue to remain 100? Answer is no. It may increase. Maybe it becomes 110. Why? Because now some more services have been rendered. Because there is one more year. So you'll add the cost to that. Plus some of the assumptions which the actuary would have considered in the year 24-25 may change. Maybe in the previous years, increment rate was considered as 5%. that this is how the increments will happen, which has increased now. Maybe the attrition rate has changed now. Yeah. So different factors, different assumptions could be there. Yes or no? Yeah. Now in this case, this liability is changing because of few factors. What is the first factor? Service cost. Okay, that we have already talked about. This liability may change because of service cost. Now that service cost could be the current service cost or the past service cost. This anyways will lead to the change in liability year on year. Okay, which is a very simple aspect to be considered. But as regards another factor, what is that? Changes in assumptions, which are going to happen each year. And why will those assumptions change? We are not saying that they have to change necessarily. We are saying they may change. Okay, they may change. And because they may change, so that's why, again, that may also become one of the factors. Yes or no? That may also become one of the factors. For what? For the change in the liability. Yeah. So one factor, of course, as we discussed, is the service cost. Second factor is the change in assumptions. So why are we moving from 100 to 110? One reason is service cost. Second reason is change in assumptions. Correct? Yeah. Now, tell me one thing. When the assumptions will change, so is it necessary that the liability will only increase? Can it also go down because of the change in the assumptions? What do you think? Tell me quickly. Navneet says yes, it may also go down. It's not necessary. Yeah, Shamli has the same answer. Very good. Ashlesha says no, it may come down as well. Yeah. So that means it's clear that liability may either go up or go down. See, because of the service cost each year, liability will only increase. So if you look at this factor, this will lead to increase in liability year on year. There is no doubt about it. But if you look at this factor, this may increase the liability or reduce the liability. But one thing is for sure, that because it's an amount which is required to be paid after a long period of time. As on today, see, we are sitting in this year. As on today, we don't know with 100% accuracy what will be the amount paid. So that's why one thing is for sure, that this amount will always be an estimate. And that's why we say actuarial valuation is nothing but an estimate. Yes or no? Actuarial valuation, that's why is always considered to be an estimate. Correct? Now, if this liability goes up or goes down because of these changes in assumptions, so the component that you will have of the change, what do you call it as? Actuarial gain or loss. See, the component of the change in the liability that you will have, because of the changes in assumptions. If the liability goes up, it will be an expense, which is actuarial loss. If the liability goes down, it will be a kind of reversal of liability. That's an income. That is what you call as actuarial gain. So each year, therefore, when you estimate this liability, what will you have? Actuarial gain or loss, which is arising on the estimation. And what do you understand about actuarial gain or loss? Actuarial gain or loss is nothing but the liability changes which are arising due to the changes in the assumptions of the actuary. Okay, which are arising due to the changes in the assumptions of the actuary. Okay, I think Anil has the same answer. Very good. Now, in this case, there are few terms which we need to understand. But before we get on to those terms, I'll quickly touch upon one more concept. Though we don't need to deep dive into that concept. Okay. So please don't try to stretch this concept. That is not really required. See, today we are looking at which financial year? 24-25. We are having this reporting year 24-25. Correct? So when do we need to record this liability? In 24-25. Right? And when is this liability payable? Tell me, when is this liability payable? Is this payable in 24-25? Over to you quickly. When is this liability payable? What do you think? This liability is payable in future. Archana says 25-26. No, it's not 25-26. I'm saying when is this liability payable? Great. Minu says at the time of retirement. Minu, again, I would request, please send your responses in the chat for everyone. It's very difficult to track individually. Yeah? So please, please enable your chat for everyone when you are sending your chats. Okay. Pooja says at the time of retirement. Now, at the time of retirement means what? Currently, we have assumed retirement is at the end of 10th year. Yes. So that means today we need to record this liability, which is payable after 10 years. Yes or no? Yes or no? Correct. Now, in this case, there's a slight problem. If you were to record a liability which is payable after 10 years, so this 100 that you have estimated, okay, now at the end of 10th year, what did you estimate? Amount will be 100. This 100 is what? This is the future value. Are you required to pay this 100 today? Tell me. Are you required to pay this 100 today? No. You are required to pay this 100 after 10 years. So this 100 is what? This is nothing but the future value. Can you pass an accounting entry in your books of accounts in the financial year 24-25 at the future value? That will be wrong. That will be wrong. If you do that, it will be wrong. It will be incorrect. Yes or no? Yeah. Lakshita says yes, sir. It will be incorrect. So that's why what do you need? You need to compute its present value. Now, present value as a concept remains same. Okay, something that you cover under financial management. Yeah. So what do you need? Therefore, you need to compute the present value of this 100. How do you compute the present value? By discounting this 100. And for which, what do you need? Discounting rate, right? You'll need a discounting rate to discount this. A rate of interest will be required. What do you call that rate of interest which is used for discounting purposes? Discounting rate. And please understand that even if you look at this discounting rate, this may also keep changing year on year. Okay, so when you are discounting 100 for 24-25, let's suppose the rate is 7%. Let's suppose when you are getting to 25-26, when this liability gets updated to 110, which you then discount, then this rate may be 7.5% or maybe 6.8%. Yes or no? Yeah. So therefore, there is another factor which will get added to this, or you can say to the component of this cost of defined benefit plan. What is that? Interest cost. So why do we consider this as a component? Because when you record a liability, it will be recorded at present value. Correct? On this present value, you will also have to accrete interest, book interest year on year, so that you reach up to the final liability which will be payable in future. Right? But again, as we discussed, we don't need to deep dive into this. Huh? Yeah. So let's not get confused with this. Huh? So briefly, we just wanted to understand this point. Correct? Clear on this? All right. So any questions, any doubts, if you have, please ask me. Then we'll move further. Okay. So now what we will do is, now we will pick a few examples with the help of which we will try to get some more clarity. Okay. Great. All right. So, okay. So now let's look at this example. Okay. Yeah. Omega Limited belongs to the engineering industry, means it's into the engineering business. Company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of 6 lakhs. It wants to spend the same over the next 2 years by reducing the annual contribution to 2 lakhs instead of 5 lakhs. Average remaining life of the employees is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization of accounts, taking note of mandatory accounting standards. Over to you. What is your thought? See, there is an accounting treatment which the company is considering. Do you agree with this or not? Yes, quickly. Over to you. What do you think about this accounting treatment? Do you think it's appropriate? Yes, no, why? Yes, waiting for your response. Quickly, huh, everyone. Do you agree? Yes, Ashleisha, please go ahead. I think you have raised hand. Yes, Ashleisha, I think you raised hand. Okay, but do you want to answer this? Who will answer this? You can just Send across your responses in the chat box also. It's not necessary that you speak up on this. Quickly, everyone, what do you do? Great. Tesme says actuarial gain or loss. That's the nature over here. I think Harsh has the same response. Shlesha says it's appropriate to apportion this over the estimated useful life. Sorry, I'm saying useful life, it's the estimated life of the employee. Anil says yes, sir, because the estimate is giving favorable results, which is a gain. Okay. So now in this case, please understand what has happened. See, during the year, company has received a surplus. What is the surplus? It's a gain. Now, how does the company want to recognize this? There are two ways. Either the company will take it to the P&L straight away, or the company can apportion this. Instead of recognizing it in one go, company is saying, no, I'll not recognize it in one go. I'll just reduce the annual contribution. So basically, they just want to apportion this. But what is the nature of the surplus? It's an actuarial gain, right? Actuarial gain or loss, current service cost, past service cost, all of these are what? These are nothing but the components of the cost of defined benefit plan. And where do you take them? You will take them to P&L straight away. Do you amortize them? Amortize means, do you apportion them over a period which is other than the reporting year? Answer is no. They are taken to the P&L straight away, immediately. Okay. So what is the accounting treatment? Any such gain, any such loss that you'll have, that will go to P&L straight away. Okay. Yeah. So now, as around these components that we discussed, whether it is about current service cost, past service cost, change in assumptions, which is nothing but the actuarial gain or loss, or the interest cost, which will arise year on year. Where do they go? They will all go to P&L straight away. Do you defer them? No, you don't defer them. They will always go to P&L straight away. Clear on this? Everyone clear? Any questions, any doubts on this? Everyone clear? Please confirm quickly. Then I'll move further. Shamli is clear. Okay, great. Archana is also clear on this, right? Lakshita is also clear. Great. All right. So then I think we can now look at some more terms. See, if you look at the defined benefit plan, again, if you talk about the reporting year 24-25, in respect of this 24-25, what will you have? At the year end, entity will have to estimate the amount which is payable to the employees at the time of retirement. Let's suppose these are the retirement dates. So that means entity needs to estimate the liability. What is the liability? Obligation to pay. Yes or no? Therefore, the liability that we record for defined benefit plan, what do you call it as? DBO. Okay, so you can say it's the term which is attached to this. DBO. What is the full form of DBO? Defined benefit obligation. Obligation in respect of defined benefit plans. Right? What is a DBO? DBO is nothing but a liability. So please don't get confused that, oh, it's a new concept which has come up. No, it's a term which we are assigning to this particular liability. Correct? Now, every year, what may also happen is that in respect of this liability which is payable in future, employer is creating a fund. Possible? Tell me. See, the employer knows that this money is payable in future. So the employer may want to create a fund each year. Yes or no? Yeah. So each year when the fund is created, what will the employer do? Employer will make a contribution each year. So let's suppose 100 is the contribution in this year. 100 is the contribution in this year. 100 year. So each year some liability will be estimated and some contribution will also be made. Now this contribution which the employer makes, generally what do you see? Employer will keep investing this amount somewhere. Every year when the fund is contributed, it is invested somewhere. And what is the objective? That from the pool of the funds which is invested, this future liability will also be paid. Right? Now, this investment which the employer makes year on year in respect of this particular liability, can you tell me what will you call this as? Tell me quickly. This fund which is created by the employer, what do you call this fund as? What will be the nature of this? Will it be an expense? Will it be an income? Tell me. Ankit says EPF. Quickly. What will be the nature of this? Nagaraja says SPF. See, the nature of this fund is what? It's an asset. Yes or no? Harsh is saying it's an expense. I think you have a thought process, it's an expense. No, it's not an expense. Expense you have already recorded in respect of this liability. Now, corresponding to this expense, what is the employer doing? Employer is also making an investment somewhere. It's an investment. So will you say investment is an expense? Tell me. Can the investment become an expense? Answer is no. That is not an expense. What is that? That is an asset. Yes or no? Clear on this? That's an asset. And technically, there's a nomenclature which is assigned to this asset. What do you call this asset as? This asset is called as plan asset. Means asset for the defined benefit plan. So that's the term that you will get to see in respect of this particular asset. Right? Clear? So every time when the company will have a defined benefit plan, you may come across two terms. DBO will always be there because the liability will always be there. In some of the cases, plan assets may also be there. See, it's not necessary that the employer will invest. May or may not be the case. But liability will have to be recognized for sure. Yes or no? Yeah? Clear? Yes, Ashlesha, please go ahead. Can you please explain your query? What is your query? Ashlesha, please pick up. What is your query? Yes, Ashlesha, please go ahead. Please pick up. Over to you quickly. Okay, Ashlesha has a so no worries. Huh? So I'll just read your query. Okay, the way I've just understood. So is the company creating fund to settle this liability in future? What do you think? Over to you, everyone. Do you think this fund is created by the company to settle this liability in future? Ankit says yes. Minu says yes. That's correct. Yeah. What is the objective of investment, or what is the objective of creating this asset? So that in future, when this liability will have to be paid, so money will be drawn from this particular asset and paid to the employee. Clear? Clear on this? Yeah. All right. Any more questions? Any more doubts if you have? Quickly, huh? Any more questions? Any more doubts if you have? No? Okay. Minu has a query. Yes, Minu, please go ahead. What's your query? I understand you have a query. Yes, Minu, please pick up. Please explain your query.
Sir, I'm asking what's the role of DBO here?
Role of DBO. See,
Hmm?
DBO has no role. Do you think there is a liability on the part of the employer to pay to the employees in future?
Yes, sir.
So the nomenclature that you use for that liability is a defined benefit obligation, because you'll have to give a name to that liability. Yes or
Okay,
no?
sir.
Okay, so the standard says that this liability is defined benefit obligation. Obligation to pay this defined benefit. Clear?
Okay, sir. Yes, sir. Thank you.
Yeah. Okay, so Anil, can you please explain your query? Anil, over to you. Please go ahead. What's your query? Anil, please pick up fast.
Sir, will the defined benefit obligation uh, be treated as an asset in case the employer don't invest and will just keep aside all the funds?
Again, I'm not clear.
Sir, will the DBO treated as asset in case the employer don't invest anywhere? He just hold the funds for the future payment of the liability of employee.
Okay, so you tell me one thing. What do you think about DBO? Is DBO an asset or a liability? Forget about whether the investment is made or not. What did we discuss? Is this
So
DBO?
generally, it is an asset because he he can utilize those funds, right, for whatever the company require.
No, no. So I'm asking you that,
Sir, I'm audible.
no, no, you are audible. So my question to you is, what do you think about DBO? What is the nature of this DBO, defined benefit obligation? Do you think it's an asset or a liability?
Sir, it's an asset.
Sorry, it's an asset.
Sir, sir, it's a liability.
It's a liability. So when you say it's a liability, So why do you think this liability will change to an asset? Liability will always remain a liability. So there are two different concepts. One is a liability, one is an asset. So the name of the liability we are saying is DBO. Forget about DBO. Let's suppose
Sir.
there's a liability. Just because employer is making a contribution anywhere.
Okay.
So will you say that this liability will now become an asset for the employer? Tell me. Tell me.
No, sir.
No. So that's why
No,
please
no.
don't get confused with the terms which are used. Please understand there is one
Okay.
liability and there's an asset. For an employer, both of these things may coexist, but liability will always remain. Asset may or may not be there depending on what the employer is planning to do. Right?
Okay, sir. It
So
depends
you'll
basing
not.
on the funds utilization, right?
No, again, it doesn't remain dependent on that. Liability will always be there. So how is the liability
So then
dependent
what
on?
on what basis then on what factors
Sorry.
or what factors we do consider to classify whether it is an asset or a liability?
No,
I'm
that's what
still
I'm asking
confused,
you.
sir.
So forget about this term DBO, huh? Okay, forget about this term DBO.
Okay. Okay.
Okay, now please help me understand one point. Do you think each year entity will have to record a liability in respect of this employee benefit? Tell me.
Yes, sir, of course. The employer
Of course.
has to keep aside certain funds. Yes, sir.
Right? No, no, I'm not talking about keep aside certain funds. I'm saying,
Okay.
will the employer be required to recognize a liability each year in
Yes, sir.
respect
He
of?
has to. It's a dynamic. Yes, it's ultimate.
So that means liability will always be there each year. So that's the first
Yes,
point
sir.
you need to understand.
But
Again, let's not get
okay,
into
got
any
it, sir.
but or if. Let's pick it up one by one. Let's go step by step. Otherwise, what will happen? You will mix up. And because you are mixing up all of these things, that's why you are getting confused. So that's why I'm saying let's break it into parts. So do we now understand that
Okay, sir.
each year liability will have to be there in the books of the employer,
Yes, sir. It's of course.
right?
Yes.
Now comes the next point.
Yes, sir.
Now, in some of the cases, let's suppose employer is making an investment. Forget what for this DBO or for this liability. Let's suppose employer has invested in the mutual funds. Employer has invested in the fixed deposit. Employer has invested in a trust. What do you call that
Okay,
investment
sir.
as? Will that be
Uh,
an asset
we
or a
can call
liability?
it as asset, sir.
That will be an asset. Now, that asset you
Yes, sir.
need to find out whether it is there or not. Okay.
So
So
finally, I
each
got
year,
to conclusion
irrespective
that
of the liability that the employer will have, asset may or may not be there.
may. Yes, sir.
Liability
Now
will
I'm
always remain.
clear.
Liability will always remain. Now comes the next question.
Yes, sir.
When you record it in your books of accounts, you will want to name this liability and you will want to name this asset. Now, what are the names that you will use? Either you can assign
Sir, for
your name to it,
liability,
or you can assign my name to it, or you can assign some other name to it. That nomenclature is irrelevant. Important thing is to understand the nature. Okay,
okay, sir.
clear on this, Anil?
Okay.
Yeah.
Yes, sir. Ultimate. Yes.
Okay, great.
Yes, sir.
Sure. All right.
Thank you.
So then I think Mohammed has a query. Yes, Mohammed, please go ahead. Please pick up. Mohammed, you have a query. Please pick up. Over to you. Yes, Mohammed, quickly. Ankit, you have a query? Ankit, I think you have a query. Please pick up. Please explain your query. Ankit, you're there. Yeah, please pick up. Please explain your query. Quickly, huh? You can raise hand, then the team will unmute you.
Sir, good morning.
Good morning.
Okay, so I wanted to know that this DBO is only EPF or it is more than that?
See, DBO can be anything. Please understand that your
Okay,
question is is this liability EPF or it could be anything. That is again dependent on the employee benefit. So why are you
okay,
limited to EPF?
okay,
EPF is an
okay,
example. EPF is not a concept. Liability is a concept. Okay, liability is a larger thing. Now that liability could be for PF, that liability could be for borrowings, that liability could be for maybe the salary payable. Okay, so liability is a larger concept. Clear
okay,
on
okay,
this,
okay, okay.
right? Okay.
Which covers all the expenses of an employee by
Sorry,
estimating the future expenses.
sorry.
I'm saying that this cover all the expenses of an employee by estimating all the future expenses.
No, it's not about all the future expenses. Currently, if you are talking about defined benefit plan, then we are only looking at defined benefit plan. Okay, and we are estimating what is the amount of that defined benefit plan that will be payable to the employee in future. Now, those defined benefit plans could be various. Okay, you can say
Okay.
gratuity could be one defined benefit plan. PF could also become a defined benefit plan. Similarly, there could be various other defined benefit plans.
Right, right.
Understood? So those
Okay.
various means what? There are various examples. So for each type of plan, you will have a different accounting.
Mm-hmm.
Yeah. So that's the thing you
Yeah.
have to look at. Clear?
Okay, okay, sir. Okay. Thank you.
Sure. Then I understand. I think Anil Nagraja, you have a query. Please go ahead. Nagraja, you have a query. I understand you have a query, Nagraja. Please go ahead. Please pick up. Please explain your query. No query. So then I think we can move further, right? All right. So now what we will do is we'll just pick up maybe small examples to discuss on the same concept. See, we are still on defined benefit plan, and there are a lot of questions we need to consider to get more clarity around some of these concepts that we have discussed. Okay. So I'll pick up the small one. As around the defined benefit plan, some of the points that we have discussed. Projected unit credit method is used. Clear? This valuation method will require consideration of each period of service so that the future liability can be ascertained. Okay. And this requires an entity to consider the approach wherein the entity will compute the amount of defined benefit obligation. That is what you call as DBO. Okay. Now for doing this, now what will I do is I'll just pick up one example. Just a minute. Okay. So just a minute. Let me just move on to that example now. Okay. So let's pick up this one. As on 1st April X1, fair value of plan assets was rupees 1 lakh. Now, what is the meaning of fair value of plan asset? See, the plan asset is recorded at fair value. So that means company had a plan asset of rupees 1 lakh. In respect of pension plan of Zelius Limited. On 30th September X1, plan paid out benefits of 19,000. Now what has happened? Some benefits have been paid. So when you pay the benefits, payment means when you pay the liability, so you use the funds from this asset. Okay. So plan paid out benefits of 19,000. And during this period, there was also a contribution of 49,000. Means 49,000 was contributed to this plan. Okay. On 31st March X2, at the end of the year, fair value of the plan asset was 1,50,000. And present value of defined benefit obligation. Now, what is this defined benefit obligation? It's a liability. And we have discussed that how do you record this liability? You will record it at present value. Okay, so that's why, again, don't get confused of what is fair value, what is present value. We just need to simply understand there's an asset for which the value at the beginning of the year is given to you. At the end of the year, there's a liability for which its value is also given. Now, actuarial losses on the obligations for the year X1, X2 were 600. So during the year, there have been some changes in assumptions which have resulted in actuarial loss. It's not a gain, it's a loss. On 1st April X1, now what do you have? Company made following estimates. Now again, we are looking at the beginning of the year. So these are the estimates which the company made. These estimates were made based on its market studies, understanding, and prevailing prices. So what were the estimates? Interest and dividend income after the tax payable by the fund will be 9.25%. That's one. Realized and unrealized gains on plan assets after tax. 2% is the expectation. Fund administrative costs, that is 1%. Okay. So fund administrative costs, because it's a cost, so that's why they've kept it negative, because other two are sort of gains. So net, what is the expectation? What is the estimation? Estimation is that there will be a return of 10.25%. How do you get it? 9.25 plus 2, 11%. Yeah, from 11 you reduce 1, so 10.25%. Okay. So this is what the company has estimated. You are required to find expected and actual returns on the plan assets. Okay, so now in this case, what do you need? You need to compute these amounts. So I think the information is already available to you. You need to get on to the computation basis this. All right. So now what we can do is we can just start on to this. Yeah. So now I'll just wait for you to solve this first, and then I'll also get on to this solution later on. Okay. Yeah. So let's start on this. Everyone, please try to attempt this on your own, solve this, and then I'll also get on to this. Yeah. Okay. So quickly, over to you. In fact, what we can also do is we can also around the break. So what we can do is we can just continue on this maybe after the break. Yeah. In the meantime, if you want, you can just continue solving this. Right. All right. So Manish, we can take a break now. Yeah. So let's break. We'll meet after 15 minutes. All right, so let's continue on this. So if you have been able to solve this, you can just start sharing your responses. Huh? Yeah, you've covered everyone who has solved this. Please share your solution. What's the final answer you are getting? Over to you. Okay, so let's move on to the solution then. Yeah. All right. So, all right. So now in this case, now what do we have in terms of the returns? This plan asset at the beginning of the year, what was the amount? 1 lakh. Correct. And what is the expected return of the management? It's given 10.25%. So what do you get? 10,250. Now, if you look at the fund as at 30th September 2000x1, there was an inflow of 49,000 on this, and there was an outflow of 19,000 on this. So net net, what is the inflow? 30,000 is the net inflow, right? So for this 30,000 inflow, other than the opening balance, we'll have to compute some return on that as well. Yes or no? Yeah. So as at 30th September X1, the 30,000 amount which has been added to this fund, what do you do? What do you do? You'll add the return on that, right? So if you add the return on that, I think at the rate 10.25%. So it's been, I think for the purposes of calculation, taken at 5% because it's half year. Okay, you can also do the exact calculation, which is absolutely okay. So what do you get? 1500. So all in all, expected return on this plan asset for the year should be what? 11,750. Now please remember, this is the expected return. This is not the actual return. Okay, we'll have to find out what is the actual return. Now, what is the basis for you to compute the expected return? So the expected return is given in the question. Management has estimated that. Okay, but the percentage was given, amount was not given. So that's why on the basis of the management's estimated percentage return, what did we do? We calculated the actual return. We calculated the amount of expected return, right? Now, okay, so I think Meenu has a question. Meenu is asking, sir, instead of taking 5.125, they have considered 5. Yes, so that's what I told you. Huh? You can go ahead with 5.125. That is completely okay. I think just some sort of rounding they have considered. Okay, which is fine. You can take or you may not take that. It is absolutely okay. Whatever you do, you need to specify. Yeah, okay. Now, moving further. Now, what I'll do is I'll just move on to the next part. We now need to compute actual return on the plan asset. Okay. So now in respect of the actual return, what do we have? At the end of the year, now please understand this part is important. At the end of the year, fair value of the plan asset is given to us. It is 1,50,000. At the beginning of the year, fair value of plan asset is given to us. It is 1 lakh. Plus, we are also given the movement which has taken place. 9,000 is withdrawn, 49,000 is added. Correct? So now, on the basis of these balances and these amounts which are given to us, what we will try to do is we will try to compute the actual return which the fund has generated. So what do you do though? Pick up the closing balance first, 1,50,000. From the closing balance, what do you reduce? Opening balance, inflow during the year, and you also add the withdrawals which have taken place during the year. Okay, let me just show it in a different manner. If let's suppose we try to compute it in a different manner. See, the opening balance is given to us. What is that? 1 lakh. To this opening balance, there has been an addition during the year. What is that? We are given an addition of 49,000 has taken place. To the opening balance, if you add the contribution and there's a reduction, means withdrawal, which has also taken place. So that was 19,000. From the opening balance, if you add the contribution, if you reduce the withdrawal, what should you get? You should get the closing balance, ideally. Yes or no? So what should be the closing balance if you go by this information? Tell me, what should be the closing balance on the basis of this? If you try to calculate it the way I have just put it down, so what should be the closing balance? It comes out to 1,30,000. Correct? It comes out to 1,30,000. Now, actually, now this is should be. But what is the actual closing balance? See, the actual closing balance is also given to us. Yes or no? So the closing balance question says is what? It is 1,50,000. That's the closing balance. So how is it possible? That is possible when some returns would have got generated during the year, amounting to what? 20,000. So that is the balancing figure. Yes or no? So it must have happened that during the year, an actual return of 20,000 has been generated. Yes or no? Only and only then this closing balance is possible. So that's why what will be the actual return on this plan asset? 20,000. Clear on this? How do you compute this amount? Everyone? Clear on this? On the actual return. So this 20,000 is the actual return which the plan asset has generated. Yeah, everyone clear? All right, great. I think Lakshita, Linga, Tilsmi, they are clear. Neeraj is asking, sir, we can also compute the amount by making ledger? Yes, but unnecessarily. When the question is not asking you, why do you want to waste time by creating a ledger? You can do that. There's absolutely no problem. You can also make that as you're working. But in the exam, you should try to save time. Okay, so why do you want to get into a ledger? Because if you do that, that will require some additional time. Instead, you can do this. Ashlesha is asking, sir, there's a lot of other information in the question. There is an actuarial loss of 600. See, every time it is not necessary that each and every information which is available in the question is relevant. Understood? So just because some information is not used, you should not get confused unnecessarily. Clear? Yeah. So many a times what the question may do is they may add some irrelevant information. What is your objective? You have to pick up the requirement of the question. You have to pick up the requirement of the question. On the basis of the requirement of the question, you need to move. If you are able to use the entire information, that's good. If you are not able to use the entire information, that is absolutely okay. Clear? Okay, Neeraj, can you please explain your query? Neeraj, I understand your query. Can you please pick up? Can you please explain what is your query? Neeraj, over to you quickly. Neeraj, please explain. Anyone else? Any more questions? If you have. Neeraj, can you please pick up? I understand your query. I want to understand your query in detail. Huh? Can you please pick up? Yes, Neeraj, please pick up. Would appreciate if you can just speak and explain your queries. Huh? Whenever you have queries, that will be better. Yes, Neeraj, please go ahead.
गुड मॉर्निंग सर।
Good morning.
सर वो एक्सपेक्टेड रेट वाला उसका कैलकुलेशन समझ नहीं आया कि हम लोग कैलकुलेशन वैसे क्यों कर रहे हैं, दूसरे तरीके से कैसे नहीं कर रहे हैं, उसका लॉजिक समझ में नहीं आया।
No, what do you mean by दूसरा तरीका? So is there any other way you think basis which you can compute the expected return?
सर जैसे बुक में दे रखा है, आपने फिर दूसरे तरीके से समझाया, तो वैसे ही मैं देखा
No,
दूसरे
no, no. So the way it is given in the book and the way I have explained, that is about actual return. That is not expected return. I think therein you are confused. Huh? So that is
हाँ
actual return. That is not expected return.
सर, कैलकुलेशन में ही दिक्कत है एक्सपेक्टेड रिटर्न के।
No, are you talking about expected return or actual return? Because the way it's given in the book, the same way I have explained.
सर एक्सपेक्टेड रिटर्न।
Expected return. Okay, let me just go back to this expected return. Huh? Okay, and let's try to understand. Now, where do you have the confusion? So we have an opening balance of 1 lakh, correct, Neeraj?
यस सर।
Now, on the opening balance, what is the percentage you will apply? Is that
10.2।
given to you in the question?
यस सर।
So what do you get? 10,250 you will get?
यस।
Is this part clear to you? 10,250? Neeraj, are you there?
यस सर। यस सर।
10,250 is clear?
यस सर।
Okay, now next amount 1,500. Now, how do you get 1,500? 30,000 is the net inflow. 49,000 is the inflow. 19,000 is the outflow. On the outflow, do you generate any return? No. So net, what is the inflow? 30,000 during the year, other than the opening balance. So on this 30,000, again, you will compute the return, but will you compute the return for full year? No, you will compute it for half year. So what is the amount you will get? 1,500. So
सर
if you
ये जो
compute, sorry,
सर ये जो 30,000 है, ये कंपनी जो एम्प्लॉयर है वो कंट्रीब्यूट कर रहा है क्या?
see, the plan asset is for whom? Who has the plan asset? Company or the employee?
एम्प्लॉय
Tell me.
सर कंपनी।
Company. So we are looking at the books of accounts of company or the employee?
Company.
Company. So that means it has to be for the company only, isn't it? We are not looking at the books of accounts of employee. So why are you confused on this?
Sir.
Everything that we have is for the company only. Right?
Yes, sir.
Yeah. So the company has contributed 49,000 to this fund during the year. They have added to this fund. Let's suppose they have invested in fixed deposit. So they have made further investment of 49,000 during the year. Plus, during the year, they also required some funds. So they withdrew 19,000. So 19,000 was the withdrawal, 49,000 was the deposit. So what is the net amount they have added to this fund? 30,000.
Yes, sir.
Clear? Clear on this,
Yes, sir.
Neeraj? Yeah,
Yes,
so
sir. Clear.
1500 is also clear. I think this is how expected return is computed. Now clear?
Yes, sir. Clear. Thank you, sir.
All right. Anyone else? Any more questions on this? What do you? Any more questions? Any more doubts if you have? Vikas, I understand you have a query. Please explain. Vikas, over to you. Vikas, please pick up. Okay, so I think Ashlesha is looking for that working file. Minu, I think you have a query. Please explain. What is your query? Yes, Minu, please pick up. Vikas, if you have a query, please pick up.
Sir, just asking that expected rate changes every year.
Expected changes means what is expected?
Expected rate means discounting rate, right?
No. Expected return. It's not a discounting rate. Discounting rate you'll use for the liability.
Okay.
Expected return. Okay, let's suppose if you invest your money somewhere. So
Okay.
you'll have some expectation that this is the amount I'll be able to generate. It's
Okay.
an asset. Okay. On the asset, you will have an expected return. On the
Okay, sir.
liability, you will never have expectation. On the liability, you will have an obligation.
Mm.
Yes or no?
Okay, sir. Yes, sir. Now
Okay.
understand.
Right.
I just correlate the discounting factor and this I expected it, so I just got confused. Thank
Correct.
you.
But that you should not do. Okay.
Yes, sir.
These two are different.
Okay, sir. Thank you.
Right. Archana, please explain. What is your query? Quickly,
Sir, I was just asking ki, uh, which which we have the solution in the study material.
Hmm.
In the exam point of view, we will be doing the same, or as you have explained in the simple manner, it will be also
See,
can be
both of
taken.
them are simple manner. The way you understand is okay. So it is up to you. It doesn't matter the way it's solved over there. So maybe so what study has done is study has started with the closing balance. I have started with the opening balance. So both of them remain same. Okay. It doesn't matter whichever way you want to put it across.
Okay, sir.
Clear?
Yeah.
Okay. I think Aditya has a query. Yes, Aditya, please explain. Aditya, over to you.
Sir, good morning, sir.
Good morning.
Sir, how 5% taken, sir? I have doubt.
5%. Are you
30,000.
talking about expected return calculation? Is it?
Yes, sir. Yes, sir.
Okay.
10.25% are also shown, but 5% have we taken.
No, so I think we already discussed this. On 30,000, the return which you will calculate, you'll do that for half year or not?
Half year, yes, sir. Half year.
Yeah. So there are two ways.
Yes,
Either
sir.
you pick up 10.25, compute it for 6 months, or you do half of this percentage. Okay, so if you do half of this percentage, then what will you get? 5.12. Okay, now what they have done is they have ignored the decimal places. They have just simply considered 5. Okay,
Yes,
so
sir.
this is what
Sir,
they have done.
if they show, sir, if they show 3 months, what should we do, sir? 3 months.
Does it really matter? As I told you, it's up to you the way you want to calculate. Either you can take 10.25 computed for 3 months, or you divide this 10.25 by 4. That's one and the same thing. Okay, so
Yes, sir. Yes.
there's unnecessary confusion on this. So tell me one thing. Let's suppose if I say 10.25 multiply by 6 by 12, or if I say 5.125, don't you think both of them are same?
That
Tell
is
me.
the same.
They are same. So the same goes with 3 months, same goes with 2 months. So let's suppose another student asks me, sir, what if there is 1 month? Does it matter? No. It's up to you, the
Sir.
way you want to compute it. Okay. Anyways, because the solution is given, so some way they will have to demonstrate or not. Okay. So they can't put down each and every method in the study material. So that's why they've given only one method. Right? It's the
Okay, sir.
way you
Okay, okay.
want to
Thank you,
work
sir.
it out. Right? So you can work it out the way you feel comfortable. Everything is same. Whatever you follow, that will remain same because it's all arithmetics. Huh? So the calculation will not
Yes, sir.
change. Clear?
Yes, sir. Yes, sir. Okay, okay.
Great. All right. Any more questions? Any more doubts if you have? No? Okay. So then what we can do is we can just move on to the next one. Okay. So let's pick up the next one. All right. So now moving on to the next question. Illustration 8. Rockstar Limited discontinues a business segment. Discontinues means they are in a way shutting down this particular segment. Under the agreement with the employees union. So it seems they have an agreement with the employee union. Employees of the discontinued segment will earn no further benefit. Okay. This is a curtailment without settlement because employees will continue to receive benefits for the services rendered before discontinuance of the business segment. Curtailment reduces the gross obligation for various reasons, including the changes in actuarial assumptions made before curtailment. If the benefits are determined based on the last pay drawn by the employees, gross obligation reduces after the curtailment because the last pay earlier assumed is no longer valid. Now, in this case, what do you have? Rockstar Limited estimates that the share of unamortized service cost that relates to the part of the obligation at rupees 18. So how do you get 18? 10% of 180. So unamortized service cost is what? 180. Calculate the gain from curtailment and liability after curtailment to be recognized in the balance sheet of Rockstar on the basis of following information. Immediately before the curtailment, gross obligation is estimated at 6,000. Fair value of plan asset on the date is 5,100. Unamortized past service cost is 180. Curtailment reduces the obligation by 600, which is 10% of the gross obligation. Okay, so let's look at this. Now in this case, What is the reduction in the gross obligation? What is the reduction in the gross obligation? It is 600. It is given to you in the question. What is gross obligation? That is your liability. Okay. Now, corresponding to this, there is an unamortized cost. Unamortized cost, you can say it's a deferred cost, which you are carrying in the books. So when you are reducing the liability by 10%, why it is 10%? It is given in the question. It is 10%. So that's why this unamortized cost will also be reduced by the 10%. Okay. So the liability you will reduce by 600, and unamortized cost portion. Unamortized cost is kind of an asset. So how do you present it? Any deferred cost that will go under asset. So your asset will also be reduced by 18. So what is the net benefit? So when you reduce your liability, is that an income for you or not? Is that a benefit for you or not? Tell me. When the liability is reduced, when the liability is sort of removed, does it result in a benefit for the company, an income for the company or not? Is it a gain? Minu says yes. So therefore, in this case, what do you have? Therefore, in this case, what do you have? 600 is the total reduction, out of which 18 is the adjustment. So what is the gain from the curtailment? 582. 582. Right? Now, what is the amount of liability that will be recognized after curtailment in the balance sheet? So your gross obligation was 6,000 earlier. Now this gets reduced to 5,400. From this, what do? You have a plan asset. So what is the amount of plan asset given in the question? 5,100. Okay. Now, see, whenever there is a liability and asset, both of them are available. So how do you present it in the balance sheet? You present it on a net basis. You don't show the liability on a gross basis and asset on a gross basis. They are always presented on a net basis. Correct? So when the liability is 5,400 and the asset amount is 5,100, so what is the net liability that you have? 300. 300 is the net liability that you have in the balance sheet. Correct? Now, against this net liability of 300, we also have a deferred cost. Correct? So 180, if you remember, was the deferred cost. Out of this 180, 18 we have reduced. So what is left? 162 is left. So if you adjust this deferred cost against the liability, what do you get? What do you get? 138. So 138 is the liability that you will have in the balance sheet. Clear on this? Everyone clear? So this is how you will be presenting this in the balance sheet. Okay? Clear? Everyone? Right. So I think Harsh is asking, sir, solve this question by your, see, this is my way. Huh? So my way is not going to change, but if you want, I can just present it over there. Linga is clear, Neeraj is clear. No worries. So let me just get on to the working file also. Okay, so now let me just try to put it in a slightly different manner. See, currently what do you have? You have a liability. Gross liability, 600. And there's a deferred cost of 180. So this deferred cost, where do you present it? You will present it on the asset side. Now the question says 10% is reduced from this. Sorry, this is 10%. So sorry. Let me just change this number. So this is 6,000. So 10% is reduced from this. 600 goes out and 10% is reduced from this. Right? So what are you left with? 5,400 and 160. Okay, so this is first part. So when your liability is reduced by 600, asset is reduced by 18, what do you get? Net 582 is the gain. Okay, so this is the gain that you get, 580. Correct? Right? Now, moving further. Now, if you look at the overall situation, you have a liability gross amounting to 5,400 after the deduction. You have a deferred cost, which is an asset amounting to 162. Plus, you have a plan asset amounting to 5,100. Now what is the objective? Idea is to present these assets and liabilities in the balance sheet. So how do you present them? There are two ways. You can show the liability separately and show both of these assets separately. But this is not how you do this. They are always presented on a net basis. So what is going to be the net presentation? So first of all, you will put down the liability gross 5,400. Okay. From this, what do you do? Plan asset. You will reduce 5,100. So what are you left with? 300. From this 300, what do you do? This particular asset. Okay. Just a minute. So this particular asset also needs to be adjusted. So the deferred cost. So this particular asset. Again, you will present it here. 162. So what do you get? You get 138. So in the balance sheet, this net balance will be shown. So this 138 will be what? This will be the net liability. Clear on this? Yeah. Now clear? I think Harsh, you were asking for this presentation. Harsh, you are clear on this now? Harsh, you are clear? Over to you. Harsh, you are clear on this now? Tell me. Ashlesha is clear. Harsh, you are clear. I understand. Anil, you have a query. Yes, Anil, please go ahead. Please pick up. Anil?
Sir, earlier you said we should not amortize. We should directly post in a P&L, right?
No, what do you mean
Whatever the
by I
actual
said?
gains or
No.
losses.
Yes, that's correct. Okay, please go ahead. Yes, continue.
But now you're differing the actual gain and loss. I'm confused with.
You are confused with these two things, huh? Correct?
Yes, sir. Yes, sir.
Okay, all right. Yeah, so let's try to understand. See, I can see a lot of confusions which most of you are having is because you are mixing up different concepts at different places. As regards the liability, let's talk about this liability. Okay, so let's suppose you have a liability of 6,000 and corresponding to this liability of 6,000, what do you have? You have a plan asset of 5,100. Correct? Forget about the reduction in the liability. So let's suppose we are looking at 2 years. This is year 1. This is year 2. Now let's suppose we are looking at the closing balance of year 2. Okay, let's suppose we are somewhere over here, year 2. And over here, what do you have? You have a liability equivalent to 6,000. You have a plan asset equivalent to 5,100. Right? Now, at the end of year 1, we don't know the amount, but this liability and asset would have been present at the end of year 1 as well. Tell me. Anil, you're there. At the end of year 1, some amount of liabilities, some amount of plan asset would have been there. Yes or no? Anil, what do you think? Some amount would have been there at the beginning of the year? Yes, I'm waiting for a response. Anil?
Yes, sir.
Yes?
Yes, sir. We have to present it at the year end.
No, it's not about you have to present it. My question is different. I'm saying at the beginning of the year, this liability must be having some amount. This
Yes,
asset
sir.
must be having some amount. It is not necessary
Yes, sir.
that this would have been 6,000 or 5,100 at the beginning. So let's assume.
It may vary.
Right,
Yes.
it may vary. Very good. So let's assume the balance of the asset at the beginning of the year was 4,800. And the balance of the liability at the beginning of the year was, say, 5,200. Okay, and during the year, what has
Okay,
happened?
sir.
This liability has changed from 5,200 to 6,000.
Yes,
This
sir.
asset has changed from 4,800 to 5,100. So the point that we discussed earlier, that if let's suppose this change in the liability is arising, why? Because there's a change in actuarial assumptions. Possible. Let's suppose this liability has
Yes. Yes,
increased
sir.
from 5,200 to 6,000. Why? Because actuarial assumptions have changed.
Yes, sir.
Okay. So now, where do you take this change? So you'll have to pass an accounting entry. So in year 2, what is the accounting entry you'll pass? Your liability to begin with was 5,200 and this has increased to 6,000. So what is the accounting entry you'll pass? You will say to liability
Liable.
800.
To liability.
800. Why 800? Because you will increase the liability by 800. So where do you take the impact?
5,200 to 6,000.
So we'll say
To
actuarial
actual
gain, or let me just call it as
gain
loss. You will say
loss.
loss debit 800. Correct. So this is the accounting entry you should pass. In that case,
Yes, sir.
this actuarial gain is what, or loss is what you will take to the P&L straight away. This you will not amortize.
Okay.
This you will not amortize. Okay. Now, at the end of the
Okay.
year, what will you have? Let's suppose when you present it in the balance sheet. Now, what are we saying here? Let's suppose you are presenting the balance sheet. Now, in the balance sheet, when you present the liability and when you present the asset, so there are two ways. Either you present the liability as 6,000, present the asset as 5,100. Instead of doing that, what are we saying here? You can't do this. This is called as gross presentation. That is what you will not do. What will you do? Within the liability, you will reduce asset. Okay, so you will not do this. You will reduce asset 5,100. So 900 is the net amount. And that's why in the balance sheet, when you will present your liability, what will you say? Net liability. You will not call it as a liability. You will call it as net liability. So this word net you will see. So every time you pick up the financial statements, okay, just pick up the financial statements, you will get to see this term. Net will be written over there. Clear?
Yes, sir.
Now clear on this?
Yes, sir. Yes, sir, I got it. Actually, we are presenting on a net basis to give impact to the P&L, right?
No, we are presenting on a net basis because the standard requires to be presented on a net basis, not to give impact to
So
the
either we have to post in a P&L, or we have to, or else we have to post in a balance sheet on a net basis, right?
No, it's not again either of these. The only way available is you have to present it on a net basis. It's not either of these two. It's the only
Okay,
option which
sir.
is available by the standard. So you can't say that
Sir,
I
in
can
what
choose to present
circumstances?
gross, I can choose to present net. No.
Sir, then in what circumstances we need to carry to P&L straight away?
In every circumstance, you'll take it to the P&L straight away.
But here we are not taking to P&Ls, right, sir?
So who says we are not taking to the P&L? Where do you
Okay,
find
okay,
that?
got it. Okay, that is why we are presenting in not basis. Okay, sir, got it. Thank you.
Clear?
Okay, sir, got it. Confused
All right.
actually. Okay,
All right.
thank you, sir.
No worries.
Thank you so
Sure.
much.
All right. Anyone else? Any more questions on this? Any more questions? Quickly, huh? Any more questions? Any more doubts if you have? No? All right. So now. Yeah, everyone clear? All right. So now. See, of course, we can practice few more questions on the defined benefit plans. But I'm just not planning to do that now because the time is limited. So that's why maybe we'll pick up some more questions on this in the next session. So what I'll do is I'll just move on to the other employee benefits. If you remember, if you go back to our discussion, there were 4 types of employee benefits that we discussed. Remember? Yeah. Short-term, post-employment, termination, other long-term. Yeah. So now what we will do is we'll just move on to the other benefits. So the third one is termination benefit. Now, what is termination benefit? Let's try to understand. Termination benefit means any benefit which is payable to the employee at the time of termination before the normal retirement date. Okay, which is payable to the employee before termination, sorry, at the time of termination before the normal retirement date. Let's suppose the normal retirement date of the employee is say 2029. Employee is terminated on 26th October 2025. And because of this termination, some employee benefit is payable to that particular employee. See, when the employee will be terminated, he must be getting services, or he must be getting salary, he must be getting bonus. All of those benefits which are there, those will be payable to him. Okay. Means whatever he has earned, he'll get it. But let's suppose due to his termination, entity has announced some additional benefits to be payable to him. That is what you call as termination benefit. For example, say there is an entity A Limited. Okay. It has got 3 plants. P1, P2, P3. These are the 3 plants. Now the company is planning to shut down P1. It's a loss-making business. So that's why, what is the plan of the company? They will shut down this plant. So the company is not going to be closed. So company will continue. One of their business segment, you can say, one of their plants will be shut down. Now let's suppose there are some 100 employees who are working in this plant. Now what will happen? When the company will discontinue its business or maybe its segment, some of these employees will be moved to the other business segment. Let's suppose 40 will be moved to P2, 20 will be moved to P3. Now 40 are still left. Now, as around those remaining 40, company doesn't have any plan, okay, to relocate. So that's why what will happen? Company will have to discontinue the services of those 40 employees. And that's why company has announced that, okay, these employees will have to be terminated and they will get some benefits. Okay. Generally, this is what the company will do. Right? This is what you call as a termination benefit. Clear on this? This is what you call as a termination benefit. Now, in this case, question arises, how do you recognize this? When do you recognize this? Right? Now, termination benefit will be recognized as an expense which will go to the P&L straight away. Okay. So this will be recognized as an expense to be taken to the P&L straight away. So how do you recognize it? It will go to the P&L straight away. Do you defer it? No. Do you amortize it? No. Let's suppose this amount is quite significant. In such a case, do you defer it? There again, no. It will go to the P&L straight away, irrespective of the amount involved. Can the organization say, no, this amount is quite significant, so that's why I want to defer it? Otherwise, it will be a hit to the P&L, a significant hit to the P&L. No. It goes to the P&L straight away. Now comes the question, when do you recognize it? Okay. In this case, let's try to understand the requirement as to when do you recognize this. Standard says termination benefits are recognized by an enterprise as a liability and an expense only when. So when do you recognize? Only when entity has a detailed formal plan for termination. Now, what is the meaning of detailed formal plan? So let's suppose in the given example, entity is planning to shut down plant 1. But it's a plan. Nothing is finalized. Okay, it's a thought. Maybe the management is considering it. So can we say it will become a termination benefit? No. See, it has to be formalized, means it has to be documented somewhere. It has to be clear. Management should be actively involved on that. Plus, it should also be duly approved. Now, what is the meaning of duly approved? See, the management should not only have a thought, there has to be some internal approvals as well. So what is the meaning of duly approved? It must have board approval in place. Means it must be approved by the board of directors. Only then you will get to know the seriousness. Only then you will get to see that, yes, of course, it's not only a plan, it's not only a thought, but the management is committed to do this. Plus, there must also be a communication around this to the employee, which the employees have accepted. Okay, so this must become an arrangement between the employer and the employee. Yeah. So again, it should not happen that the company has a plan, they have also got this approved, so the scheme is also there, everything is documented, but this has not been communicated to the employees. So the employees are not aware of this. So what do you do? No. So this has to be communicated to the employee, which the employees would have accepted, right? Basis which a reliable estimate of the amount of such employee benefit can be made. Yeah. Once you have this criteria fulfilled, that is when you will recognize the termination benefit. And how do you record it? It will go to the P&L straight away. Everyone clear? Any questions on this? Yes, quickly, huh? Everyone clear? What is a termination benefit? Clear? Everyone clear? All right, great. Now, moving on to the next one. Next one is the residual category as well. See, there are 4 types of employee benefits that we have. Short term we discussed, post employment we discussed, termination we discussed. Now, what is the 4th one? Other long term employee benefits. Now, what is this other? Other means it has to be other than post employment and termination benefits. Means excluding these two. Now let's try to understand the meaning of long-term employee benefits. So when would an employee benefit become long-term? If you go back to our discussion on short-term employee benefits. So what did we discuss for short-term employee benefits? If let's suppose our reporting year is 24-25. So any benefit which becomes payable within 12 months from the balance sheet date, what do you call it as? Tell me, what do you call it as? Any benefit which you pay within 12 months from the balance sheet date. What do you call it as? Quickly, over to you. What do you call it as? Great. Neeraj says short-term employee benefit. I think same is the response from Linga, Shamli, Archana. Good. So this is short-term. Correct. Now what is long-term? Any benefit which becomes payable after 12 months from the balance sheet date. Now what is that period? This period. Okay. After 12 months means after 31st March 26. That is what you call as long-term employee benefit. Now, in this case, one may again get confused. So in such a case, gratuity may also be a long-term employee benefit. Yes or no? Pension can also be there, but we discussed it's post-employment. Correct. That's why we are saying it's a residual category. Long-term post-employment is also long-term. Termination can also become long-term. That's why when we are discussing about long-term, we have to exclude these two. Why? Because these are specifically covered by this respective category. So that's why you will exclude these two. Clear on this? Clear on what are other long-term employee benefits? Clear? Now, let's take an example for other long-term employee benefits. Say, during the year, now this is the reporting year. This is the reporting year. During the year, company has a policy. What is the policy of the company? That the employee will get 21 days of leaves. And out of 21, 16 are unavailed. Right? 16 are unavailed. Now, management has an expectation. What is the expectation of the management? Out of 16, 6 will be availed next year. Okay. And remaining 10 leaves will be availed next to next year. Okay. So 16 leaves are pending. 6 will be availed next year. Remaining 10 will be availed next to next year or in the future years. In this case, can you tell me the accounting treatment for these 16 leaves? Over to you. I think it's quite simple. Aditya, I'll come to your query quickly. What will be the accounting treatment of these 16 leaves? Over to you quickly. What will be the accounting treatment of these 16 leaves? Tell me quickly, how do you record this? Over to you. Ashlesha says 16 will be recorded as a liability. Very good. But how do you record it? How do you record it? Yes, so let's understand that for these 16 leaves, these 6 leaves will be recorded as short-term employee benefit. These will be recorded as short-term employee benefits, and these 10 leaves will be recorded as other long-term employee benefit. Clear on this? So 16 will be recorded, no doubt, as a liability. But what is going to be the nature? How will you record it? So these 6 you will call as short term, these 10 you will call it as other long term. Clear? Simple, easy to understand. Now comes the question that what will be the basis of computing the amount, valuing this other long term. So this is also valued using projected unit credit method through an actuary. Okay, so the same valuation methodology is required, right? Aditya, you had a query, please go ahead. So I think this is it that we had on the employee benefits for the day. So what we can do is we can just now maybe close our discussion for the day. We are not yet done on this. We'll continue with our discussion in the next session. Yeah, so that's why it's very important that when we meet next, you revise this. Okay. Now, what I'll do is I'll just move on to your queries now. Yes, Aditya, please go ahead. Please pick up what is your query. Yes, Aditya, please pick up.
Sir, if employee gets the pension, sir.
Right.
Hello.
Yes.
Employee gets the pension. It comes short term or long term, sir.
No, so again, you are
After
getting
retirement,
confused.
employee gets.
No, so in case of a pension, first of all, you need to find out whether it is short term, long term, or post employment. So there's not a straightforward answer to this. You will have to find out depending on the benefit which is there. If you say it's short term, you will treat it the way short term employee benefit is required. If you say it's post employment, you will have to record it as a post employment. Otherwise, it will become long term. Clear?
Okay, sir. Okay.
Right. Archana, can you please explain your query? Over to you.
Yeah, sir. Sir, can you please summarize the termination benefits once again, sir?
Yeah, so there's nothing to summarize. I'll just explain the termination benefit once again. See, the termination benefit, what do? You are actually looking at a situation wherein the employee is retiring before the normal retirement date. Why? Because he's terminated. So that's why some benefit is payable to him. In such a case, you call it as termination benefit, in which case the benefit which is payable to the employee, you will record it immediately, and that goes to P&L. Now comes the criteria to check that is it really payable or not. So how do you find out? You check That does the management have a scheme which is clearly approved, which is discussed with the employees, it's all done, sorted, final. Once this is final, that is when you record. It shouldn't happen that you have recorded the liability, but actually this termination benefit is not finalized. So what do? Do you reverse the liability? That's the thing, right? Then I think Ashlesha is asking, sir, is this presentation short-term, long-term goes into? No. See, it's not about presenting this in the balance sheet as a short-term or long-term only. Of course, in the accounting policy, you'll do that. It's about the basis of measurement that you will follow. See, for short-term, your basis of measurement is different. For long-term, you will have to do actuarial valuation, PUC method. That's where it is required. Clear? Clear? Ashlesha clear on this? Archana is clear? Ashlesha clear? Yeah? Okay, great. All right. So I think this is it that we had on this. Any questions, any doubts that you may have, we can discuss that. All right. Any more questions, any more doubts? Any more questions? I can see one query coming up from Vikas. Vikas, can you please explain your query? Can you please pick up? Vikas, if you have any query, can you please explain? Can you please pick up? Anyone else? Any queries if you have?
हेलो
Yes.
सर जो 16 अनअवेयर जो लीव्स थी उसको 6 और 10 में कैसा बाइफिकेट मतलब अपन अज्यूम किया या कुछ मेथड अप्लाई करा?
No, we have assumed. Management has assumed that 6 will be availed next year and 10 will be availed next to next year. So that's the assumption. Every time management will have to estimate. Okay. All right. So Vikas is clear. Linga is clear. No further questions. Okay. So if you do not have any further questions, we can just close this. Okay, great. Nagaraja has a query. Yes, Nagaraj, please go ahead.
Yes, sir. Following Account Standard 15 can indirectly reduce the tax liability of a company.
Sorry?
Following Account Standard 15 can indirectly reduce the tax liability of a company.
What do you mean by indirectly tax liability of the company? Please explain. Huh? I'm not clear.
Like recognize all employee benefits, sir.
Uh-huh. I'm not
The
clear on
short-term
your query. Can you please explain properly?
Following Account Standard 15, the employee benefits can indirectly reduce the tax liability of a company.
See, why will it be a tax liability? Because for a company, it's an expense. It's not an income. Employee benefit, do you think it's an income for the company? Tell me. Do you think it's a income for the company? Nagaraja, you're there?
So why are this Account Standard 15 follow the company? Why?
Why is it followed? Because it's an expense for the company. So the accounting standard is required to explain the basis of recognition, measurement of such an expense, like you have for any other accounting standard. Okay, each and every standard is dealing with some of the transactions, some of the arrangements. So for these arrangements with the employees, you have this accounting standard. Do you have the accounting standards because the tax is calculated using that? Accounting standards are not there to help the company compute the income tax. Accounting standards are there to help the company to look at the accounting treatment of different types of transactions or the arrangements. Yes or no? Clear? Nagaraj, clear on this?
Yes, sir.
Okay. Anil, you have a query? Please pick up.
Sir, it will
Anil, you are not audible. Anil, you are
impact
not audible.
on tax, right?
No, Anil, there seems to be some network issue. Huh? You are not audible. Huh? Please. Okay. Anyone else? Any more questions on this? No? All right. So then I think we can just close this discussion. Yeah. But very, very important. Before we meet next, just make sure you revise this. And we'll continue on this, and we'll also start with a new accounting standard in the next session. Thanks, everyone. Yeah, Manish. Yes.